Hello, this is Jordan, and this video is being recorded ahead of the morning of Monday, January 10th, 2022. Thank you so much for joining me. Please like, comment, and subscribe. And if you haven't already done so, make sure you subscribe. I have a lot more content coming for you guys this year. And in this video, I'm going to talk about the Fed rate hike cycle and what that could mean for gold's trajectory. So we have already established that historically, gold makes major bottoms when the Fed starts hiking rates. You can look at my videos, read my articles. We've established that. Another thing, last week we had the Fed minutes. They were more hawkish. Fed funds futures at one point showed an 80% chance of a rate hike in March. So they're likely to start hiking in March. So at this point, that's what I'm looking for, a spring bottom in precious metals. Should be a significant low. But, what happens after they start hiking and we get that rally? That is the real question. Now, in this chart, we have the Fed funds rate at the top. We have gold below. The vertical lines, they show the start of the rate hike cycles. There's 8 of them. And the yellow shows periods of rising rates. Now, going back to the 70s, for the most part, for the 70s through the 90s, gold was mostly correlated with rising nominal rates. So as the Fed hiked, gold, during that period, typically performed well. And I would just guess, even though real interest rates in the 80s and 90s were strongly positive, there was rising inflation during those cycles. And even with the secular inflation rate was coming down, there were periods where you had rising inflation. Now, obviously, in the 70s, you had accelerating inflation. So that, is a key distinction. And the last 3 cycles have been different than the previous ones. First off, we should note 2 major bottoms in gold, 1999, 2016. Also, the 2004 low was important for gold. And, the big moves really occurred. You can see the C's there. Those show the start of rate cut cycles. Over the last 25 years, you can see that the huge moves were precipitated by the start of rate cuts. However, if we look at the mid-2000s, that is kind of the outlier in the last 25 years, because gold had a massive breakout at the end of before, a year before. It started that move a year before the Fed stopped hiking. So it did well then it consolidated. When they had to go to cuts, it broke out again. But so it's really a question of, what's bullish for gold? On the one hand, you can have the Fed hikes, but you have accelerating inflation, so they're behind the curve. And so that kind of happened. Not in the mid-2000s. If you look at the data, it was really more inflation expectations and rising inflation expectation that caused that breakout in gold. But, in the 70s, it was accelerating inflation. So that's bullish after the Fed starts hiking. The other thing that's bullish is obviously they have to stop. Now, in this chart, we have I made an analog here. First of all, I project the bottom at 1650 gold at the end of March. This is weekly data. Now, you can see 2004 to 2008. Now, the average of the last 3, how gold performed when the Fed started hiking from that bottom, the bottom in the gold price, that's in blue. Now, the average in black, average 2, that presumes the start of the last cycle was December 2016, whereas the normal average was December 2015. The reason is, remember, the Fed hiked in December 2015, but then they paused for a year. Then they hiked for 2 years. So you could make an argument the start of the cycle was really December 2016. And so if we're looking at, the 04 to 08, that line shows, now all of these, what you can see is the Fed starts hiking, you get a good rally, maybe 4, 5, 6 months. So depending on various factors, gold could rally back, retest its high, or come close, get to 2,000, something like that. later after the summer, maybe later this year. Then after that, you get a pullback. And after that, the question is, is inflation starting to accelerate? Because that could be a problem. That's bullish for gold. You can see that's when the 04 to 08 line really starts to take off. Or if the economy's weakening and the Fed is worried about that and they want to end their hikes, that also ultimately becomes a catalyst for gold. Now, it's really interesting because this cycle, the catalyst for gold breaking above 2100 for good, it's probably going to be another round of fiscal stimulus, UBI, something like that. I mean, let's just presume the Fed cutting rates. Let's say they hike for 6 months or a year, whatever. These rates get to 1.5%. They start cutting rates from there. That in itself is not going to be that massive of a catalyst. However, the Fed just stopping their rate hikes. If they pause, that's going to be good for gold. It should retest its high. But eventually, when the Fed stops hiking, if it's permanent, that's going to be obviously bullish. And, then you have potential fiscal policy really bullish. So those factors are going to determine how this cycle, how gold performs during the Fed rate hike cycle. But the good news is all of this historical data and the fact that, gold has been weak, all of this, especially if gold breaks down here below 1750, trades in the 1600s, that's going to set up for a really good rebound. Same goes for silver. So stay tuned for that. And we'll get the rally. And then, as we're rallying this year, we can assess growth, inflation, etc., and, what path gold might be following. That's all for this video. Hope it was very informative. Follow all my work at TheDailyGold.com. Thank you so much, and I'll talk to you guys again soon.